Hello everyone, Bryan here with your Las Vegas market update video for October. Now, if you've been watching for a while now, you know that many months ago I predicted a downturn in the Las Vegas housing market. While the mainstream media tends to be 6 months behind what's going on, I'm here to tell you what's really happening right now and illustrate what the market will look like 6 months from now. So finally, this month, we started to see some major cracks in the housing industry that illustrate how potentially bad next year could turn out. So today, we're going to cover the current inventory level increases. We're going to break down the current inventory in terms of short sales, foreclosures, and traditional sales, and then see what's going on with the foreclosure activity. Then we'll cover the major news topics of the month and these cracks that I alluded to earlier. Finally, we'll wrap this up and make some sense out of all this mess. Okay, so first up is the current inventory levels. About 4 months ago, I predicted that we would double our inventory from 3,000 homes in April to 6,000 by Halloween. As of today's shoot, we're already at 6,604 homes. Now, at this rate, we should end the month at about 7,000 homes. If there's any good news here, it's that we only went up about 15% last month instead of the 20% that we've been seeing for the past 6 months. But here's a dose of reality. If we average a 15% increase from now on, that means we'll have 10,000 homes on the MLS by the end of the year. When you more than triple the inventory in only 8 months without any additional short sales or foreclosures being thrown into the mix, you can only imagine what happens when the foreclosures actually do come back. Okay, next is the breakdown of this inventory. Now, out of the 6,600 homes on the market, only 819 are short sales and a paltry 378 foreclosures. Now, put differently, 13% of the market are short sales, while only 6% of the market are foreclosures. This leaves an astonishing 81% of homes that are traditional sales. All I'm going to say about these numbers is this. We've got 40,000 vacant homes waiting to be foreclosed on right now. And we've only got 378 foreclosures on the market. Yeah, just chew on that one for a while. Okay, now, one of the more pervasive changes in September was with regards to the NODs or notice of defaults. This tells us the amount of foreclosure activity that's coming down the pipeline. Now, the higher the number, the higher the amount of foreclosures down the road. So let's take a quick look at these numbers. As you can see right now, over the past 6 months, we've fluctuated from a low of only 99 in June to a high of 1,600 in April. But then there was last month. Last month, we filed 3,688 notices of default. That's the most filings in over 2 years. Now, here's the caveat. This number is overinflated and not indicative of what's really going on. On October 1st, SB 321 went into effect. This law drastically changes how the banks handle their foreclosure filings. Although the banks are finally cleared to start foreclosing again, this law requires banks to make extensive attempts 30 days prior to filing either a notice of default or a notice of trustee sale. So last month it was obvious that many banks wanted to clear their books of some properties before they had to worry about the new legislation getting in their way. Now, I can tell you that the first couple days of October, the NODs dropped to only about 15 a day. So I think that for the next few months, we're not going to see much foreclosure activity. This goes back to what I said 6 months ago. We're not going to see much foreclosure activity until next year. Then I think we're going to see a substantial amount more than we have for the past 2 years. Okay, now we're going to go into my special segment called The Tides of Change. This is where I explain to you how and why the market is declining. The big news in September was in regards to Wells Fargo and Citibank. Now, Citibank laid off 750 people alone in their Las Vegas mortgage division. Wells Fargo laid off 1,800 people, and that's after they announced 3,000 layoffs back in August. Essentially, these banks are watching mortgage applications just decrease and are proactively responding. So the moral of the story here is if the banks are betting against housing by laying people off, what do you think is going to happen next year? Okay, so speaking of banks and mortgages, this is potentially the most important topic I'm going to discuss, and nobody is even talking about it yet. Okay, so back in 2010, Obama signed into legislation the Dodd-Frank Act. Now, this was supposed to reform Wall Street and protect consumers. Well, as part of this legislation, FHFA, which stands for Federal Housing Finance Agency, had changed what they define as a qualified mortgage. Essentially, the government wants to limit the risky types of loans that are purchased by Fannie Mae and Freddie Mac. So starting on January 10th of next year, some pretty big changes are going to happen. Basically, the government is limiting how much lenders can charge up front to 3%. They won't purchase any loans with terms over 30 years and a few other restrictions. But here's two major changes that will have a large effect on our market. First is the debt-to-income ratio. Right now, the debt-to-income ratio is at 54%. This means that if your family makes, say, $10,000 a month, the sum of all your monthly obligations, including your new mortgage, cannot exceed $5,400. Well, on January 10th, this number is coming down to only 43%. Now, this is huge, especially in Las Vegas. Many buyers have high debt-to-income ratios. Dropping a borrower's debt-to-income ratio 11% is like telling a person who qualified for a $400,000 home in December that they only qualify for $300,000 in January. This is going to be a major issue in January, and most people won't even know about this till the media starts reporting in probably like December. Now, speaking of the amount that people can buy, FHFA is also in charge of what's called the conforming loan rate. This is the maximum amount a borrower can mortgage until it becomes non-conforming, or in this case, a jumbo loan. Typically, jumbo loans have lower debt ratios, higher interest rates, and increased down payments. Most buyers typically do anything they can to avoid a jumbo loan when they have the means, or if they just find themselves close enough to that limit. Well, right now, this amount is $417,000 in Las Vegas. Now, back when the market crashed, there were threats to lower the conforming rate since home values had plummeted. Well, now that the government wants to reduce the types of loans that they purchase, FHFA announced that they are planning to reduce the conforming loan limit. We don't know what amount or when they will announce it, but that could go into effect January 10th as well. So now it could drop to only $400,000, or it could drop to where we were back in 2005 at $360,000. So either way, any reduction doesn't help the housing market. If they reduce it back to $360,000, this will wreak havoc on any seller in the $400,000 price range. Okay, next has to do with hedge funds. Now, we all know that the hedge funds have been buying up about 4,000 plus homes in Las Vegas a year for the past few years. Well, originally, they stated that they would be holding these properties for like 5 to 7 years. Last month, when Colony Capital tried to go public and securitize a small portfolio of theirs, it came out that they only had a 60% occupancy rate and essentially failed to get the rating they needed and then just bagged the whole idea. Well, this past month, Oaktree and their partner, Carrington Mortgage Services, which controls about $76 billion in real estate, announced that they were selling off their properties, most of which are located in the western states. So this leads us to two questions. Why would you sell now if you think the market is great? Now, my answer is that they realize the market is going to get worse. So get out while you're ahead and take your profits while you still can. So question number 2, who's next? Now that Colony Capital failed to go public and securitize, will they bail out and sell? Blackstone has been very quiet in Las Vegas recently, and they're the largest hedge fund. So if prices begin to drop, are they going to bail out too? Okay, so last topic. For months I've been stating that new homes are going to get absolutely crushed when the market actually turns. Now, I've said that you're borderline nuts to purchase a brand new home right now with new home prices so inflated above the same resale home with a pool even. I said watch. Next year, new home builders are going to be giving away homes when people wake up and see what's going on. Well, guess what? As you can see now on the screen, this is a spreadsheet from September 6th presented by Home Builders Research, which shows the sales from all of the new home builders. So, although it's missing about 3 weeks from the completed quarter, you can pretty much get the gist here. Let me run down some names and show you what kind of impact the market has had on them. American West Homes, 222 sales in the first quarter, now 106, down 52%. Beazer Homes, 116 in the first quarter, now 42, down 64%. Del Webb, 67 homes in the first quarter, now 22, down 67%. D.R. Horton, 247 homes in the first quarter, now 85, down 66%. Harmony Homes, 136, now 67, 51% decrease. The list just goes on and on. I'll spare you. So needless to say, new home sales are down about like 60% from the first quarter. When I've spoken to my friends in the new home sales tracks, they've told me that it's been pretty quiet. So just wait till we see the fourth quarter sales, if there are any. Now, just today, I saw that Ryland Homes is offering $25,000 in incentives if you buy up in Providence. Now, at least one home builder is finally seeing the light here. Some builders, like Lennar, who have been greedy and arrogant, have only paid realtors close to like half of what the other builders are paying. I've got a strong feeling that now that they need our help selling their homes, they're going to finally pay up and want to be best friends with realtors again. So let's just quickly wrap up what we learned today. Inventory levels are still skyrocketing at a disturbing pace. The current inventory is 81% traditional sales. Foreclosure activity went through the roof last month, but should grind back to a halt in October. The major banks are laying off and betting on a housing downturn for next year. Even hedge funds are walking away now and taking their profits. Major lending changes are on the way in January, which could drastically affect the market negatively. And new home sales are down about 60% from where they were during the beginning of the year. So what do we take from this? Well, if the people with billions on the line are betting against real estate next year, I guess so am I. Everything that I warned you about for months now is coming to fruition. If you're a buyer, you really need to be careful. If your debt to income ratios are high, then you need to get with your lender and make sure that you'll still be able to purchase what you want in January. Prices will drop, but just realize that you may be caught in a catch-22. See, the home that you want may be cheaper next year, but you might not be able to even qualify thanks to government changes. So if you're a seller, my position still stands. You should have sold when I told you to months ago. But from here on out, you're battling a declining market and now the holiday season, which is typically poor for sellers. If you have a home in the $400,000 price range, you're completely mental to wait until next year, since we already know the conforming rate limit is set to be reduced, along with buyers' purchasing power. So do whatever you need to do, but make sure that you sell off quickly. Now, thank you again for watching. Please click here to subscribe, and feel free to contact me anytime with any questions or concerns you have regarding Las Vegas real estate. Have a fantastic October, everyone.